Japan's Treasury tremor, a warning sign for the U.S. economy. The U.S. economy is facing a new challenge. Japan, a longtime holder of U.S. Treasury bonds, is selling. This move is sending shockwaves through the financial world. It raises concerns about the stability of the U.S. economy. For years, Japan has been a major buyer of U.S. debt. This helped to keep U.S. interest rates low. But now Japan is changing course. The country is looking to stabilize its own economy, and it's doing so by selling off its vast holdings of U.S. Treasury bonds. This sell-off is a significant development. It signals a potential shift in global investor sentiment. The U.S. dollar could weaken, and borrowing costs for the U.S. government could rise. This situation bears close watching. The implications for the U.S. economy are potentially far-reaching. The global economy is interconnected. Actions taken by one major player can ripple outward. This is especially true when it comes to the U.S., the world's largest economy. One of the most immediate impacts of Japan's Treasury sales is the potential for rising interest rates in the U.S. This is a significant concern for both policymakers and market participants. When a major holder of U.S. debt like Japan starts selling, it increases the supply of bonds available in the market. This sudden influx can create a surplus, leading to various market reactions. This increased supply can lead to lower bond prices. Investors may start selling off their holdings, anticipating further declines in bond prices. And since bond prices and interest rates move in opposite directions, lower bond prices translate into higher interest rates. This inverse relationship is a fundamental principle of bond markets. Higher interest rates can have a ripple effect throughout the U.S. economy. The cost of borrowing increases, affecting various sectors. For businesses, it means that borrowing money to invest and expand becomes more expensive. This can deter companies from pursuing new projects or expanding their operations. This can slow down economic growth. When businesses cut back on investment, it can lead to reduced job creation and slower economic activity. For consumers, it means higher interest rates on mortgages, car loans, and credit card debt, putting a strain on household budgets. Families may find it harder to afford big-ticket items or manage their debt. The Federal Reserve, responsible for setting U.S. interest rate policy, will be closely monitoring the situation. They need to ensure that the economy remains stable. The Fed has a dual mandate of controlling inflation and maximizing employment. Balancing these two objectives can be challenging, especially in a volatile market. Rising interest rates can help to tame inflation, but can also risk slowing economic growth and increasing unemployment. The Fed must carefully consider the trade-offs. The balancing act for the Fed is a delicate one. They must navigate the complexities of the market while keeping an eye on long-term economic health. They will need to carefully weigh the potential consequences of their actions in response to Japan's Treasury sales and the broader economic conditions. Every decision they make can have far-reaching implications. Additionally, the global financial markets will be watching closely. Japan's actions can influence not just the U.S. economy, but also international economic relations. Economic analysts and financial news outlets will be providing continuous coverage and analysis. Their insights can help investors and policymakers make informed decisions. Looking at historical data on Treasury sales and previous market reactions can offer valuable lessons. Understanding past trends can help predict future outcomes. Investors will need to strategize carefully. Market strategy planning becomes crucial in times of uncertainty. Ultimately, the resilience of the economy will be tested. Long-term economic planning and adaptability will be key to navigating these challenges. The future economic outlook will depend on how well these factors are managed. Both optimistic and cautious perspectives will shape the narrative in the coming months. In summary, Japan's Treasury sales have immediate and far-reaching impacts. From rising interest rates to broader economic implications, the situation requires careful monitoring and strategic responses. Market jitters: how stocks and bonds react to Treasury sales. The financial markets are a complex web of interrelated factors, and understanding how they react to significant events like Treasury sales can provide valuable insights for investors. The stock market is known for its sensitivity to economic news. Even the slightest hint of a change in economic policy or a major financial event can send ripples through the market, causing fluctuations in stock prices. And news of Japan's Treasury bond sell-off is likely to cause some jitters. Investors around the world keep a close eye on such developments, as they can have far-reaching implications for global financial stability. As interest rates rise in response to the increased bond supply, investors may shift their money away from stocks and into bonds. This is because bonds, particularly government bonds, are often seen as a safer investment during times of uncertainty. Bonds, now offering a higher return, become a more attractive investment compared to the potentially volatile stock market. The increased demand for bonds can drive up their prices, further influencing the overall market dynamics. This shift in investor sentiment can lead to a decline in stock prices. When a significant number of investors move their money out of stocks and into bonds, the reduced demand for stocks can cause their prices to drop. Certain sectors of the economy, particularly those sensitive to interest rate changes like housing and construction, may experience more pronounced declines. Higher interest rates can lead to higher borrowing costs, which can slow down economic activity in these sectors. Companies that rely heavily on borrowing for growth may also see their stock prices suffer. Higher interest rates mean higher costs for borrowing, which can reduce profitability and lead to lower stock valuations.
The bond market itself will also be closely watched. Investors will be keen to see how the increased supply of bonds affects their prices and yields. The yield on the 10-year U.S. Treasury note, a benchmark for long-term interest rates, will be a key indicator of investor sentiment. A rising yield can indicate that investors are demanding higher returns for holding government debt, which can be a sign of increased risk perception. A sharp rise in the 10-year yield could signal growing concerns about inflation and the future direction of the U.S. economy. Inflation erodes the purchasing power of money, and higher yields can be a reflection of investors' expectations of higher inflation in the future. Volatility is likely to be the name of the game in the coming weeks and months. As investors react to new information and adjust their portfolios, we can expect to see significant swings in both the stock and bond markets. Investors will be looking for signs of stability and clarity regarding the future path of interest rates and economic growth. Clear communication from policymakers and positive economic indicators can help to calm the markets and reduce uncertainty.
Why Japan is selling, a look at their economic strategy. Japanese economist. Japan's decision to sell U.S. Treasury bonds is not a sudden, isolated event. It is a calculated move that fits into a larger, more comprehensive economic strategy. It's part of a broader strategy to address challenges within our own economy. The Japanese government and financial experts have been meticulously planning this approach for years. For years, Japan has grappled with slow economic growth and deflation, which has been a persistent issue affecting various sectors of the economy. Deflation is a sustained decrease in the general price level of goods and services, which can lead to reduced consumer spending and lower business profits. To combat these issues, Japan has implemented a range of monetary policy measures, including aggressive fiscal policies and structural reforms aimed at revitalizing the economy. These measures include keeping interest rates extremely low and engaging in quantitative easing, which is designed to increase the money supply and encourage lending and investment. Quantitative easing is a strategy where the central bank injects money into the economy by purchasing assets, such as government bonds, to lower interest rates and increase liquidity. However, these measures have had limited success in stimulating significant economic growth. The challenges remain, and the government continues to seek effective solutions. Now, Japan is shifting its focus towards strengthening its own currency, the yen. A stronger yen can help stabilize the economy and improve purchasing power for Japanese consumers. A weaker yen has made Japanese exports more competitive globally, boosting the manufacturing sector and increasing trade surpluses. But it has also contributed to rising import costs, putting pressure on Japanese consumers who face higher prices for imported goods and services. By selling U.S. Treasury bonds, Japan can increase demand for the yen, which can help strengthen the currency and reduce the cost of imports. This move could potentially lead to a stronger currency, which would have a ripple effect on the economy, influencing everything from consumer prices to international trade dynamics. This move highlights the interconnectedness of the global economy. The actions of one country can have far-reaching effects on the economic stability and policies of other nations. Actions taken by one country to address its own economic challenges can have unintended consequences for others, underscoring the importance of international cooperation and dialogue in economic policymaking. The growing problem of U.S. debt. U.S. financial analyst. Japan's sell-off of U.S. Treasury bonds shines a light on a growing concern: the United States' massive national debt. For decades, the U.S. has run budget deficits, spending more money than it takes in through revenue. This has led to a steady accumulation of debt. To finance this debt, the U.S. Treasury issues bonds, essentially borrowing money from investors, both domestic and foreign. Japan has been a major holder of this debt, but their recent selling spree raises concerns about who will step in to fill the void. U.S. financial analyst. If demand for U.S. Treasury bonds weakens, it could force the U.S. government to offer higher interest rates to attract buyers. This would further increase the cost of servicing the national debt, potentially crowding out other essential government spending programs. The growing debt burden also raises concerns about the long-term stability of the U.S. economy. While the U.S. has always been able to meet its debt obligations, the sheer size of the debt is unsustainable in the long run.